Good evening and welcome to the Wealth Empire Weekly Market Video. Last week concluded the Berkshire Hathaway 50th anniversary shareholder meeting, and for all those who attended, I've heard nothing but great things. What we'd like to do now is go ahead and continue our three-part series on Warren Buffett. Now, we've been doing this study called Testing the Warren Buffett Method, and tonight we'll continue with the third and final part 3. Now, the first two parts of this study were covered in previous videos. If you've not already seen them, I encourage you to do so. This week will be the conclusion of our test of the Warren Buffett method. In parts 1 and 2, we showed fairly conclusive evidence supporting Buffett's preference for companies with proven and predictable earnings. These stocks not only outperformed the rest of the group over a 10-year period, but they also offered less risk. We will now test his final two criterion. 3 was paying a reasonable price. Now, Buffett's third investment criterion is to pay a reasonable price, and of all the studied components of the stock market and security analysis, price is the most frequently overlooked. What most people fail to realize is the same stock can be a great investment at one price and a lousy one at another. Finding quality businesses worth your investment dollar is only the first piece of the puzzle. For Buffett, it must be offered at a price or at a fair price, or an investment opportunity does not exist. He's been quoted as saying, "Price is what you pay, value is what you get." Now, most investors give little attention to whether a stock's quoted price accurately reflects its value. They scan for today's quote and immediately assume that to be a fair reflection of the company's value. But Buffett takes a very different approach. He doesn't watch stock quotes. In fact, he doesn't even have a computer in his office. He uses what is known as bottoms-up analysis. Warren studies company financials, makes some assumptions based on their past history, and then produces a rough estimate of what he believes the stock should be worth today. If shares are trading at a substantial discount to this figure, he buys. If trading at a premium, he moves on and looks for the next opportunity. He refers to this as a margin of safety. This term represents an investment's discount to value. If he finds a stock to have a value of $50 per share, and it currently trades for $25, it's offering a 50% margin of safety. If the same stock were trading for $60, no margin of safety would exist. Without going too in-depth about market valuation in this article, just know that valuation is important. Paying a reasonable price, as Buffett recommends, is of the utmost importance for superior performance in the equity market. Now, in order to apply Buffett's second investment criterion to our stock examination, we'll be dividing our original 2,403 stocks into 3 groups: undervalued, fair valued, and overvalued. To do this, we'll use a simple metric called PEPG to value the stocks. PEPG is the price-to-earnings ratio over past growth. It divides the PE ratio by the average EBITDA growth rate over the last 5 years. Now, PE is probably the most common metric used to evaluate stocks. It produces a simple number that reflects how many times you're paying for 1 year of the stock's earnings. All things being equal, the lower the better, since it means you're getting more company earnings for each of your investment dollars. For this study, PEPG was used instead, since it incorporates the growth of the underlying business. Investors remain divided over which is more important, value or growth, so this metric is ideal since it incorporates both. If PEPG of a stock is between 0 and 1, we consider it undervalued. If it's between 1 and 2, we consider it fair valued. And finally, a PEPG above 2 represents an overvalued stock. This is a fairly rough measure of value, but it'll serve our purposes for comparing the correlation between investor value and stock performance. Now, here's a look at our results. We broke these into 2 groups, one being the top 100 most predictable companies using our previous 2 studies, and then the second 100 most predictable companies, and then ranked the stocks within these groups by their undervalued, fair valued, or overvalued statistics based on this PEPG metric. And look what we found. Once again, Warren's preference for undervalued stocks is outperforming its overvalued counterparts. In both groups, the undervalued stocks had annualized, median, and total average gains far in excess of their fair and overvalued counterparts. We see this in both groups. Now remember, we're looking at the 200 most predictable companies. So we're already looking at the creme de la creme based on Buffett's previous criterion. And we quickly see that even from this elite group of predictable companies, those that were offered at the largest discount to value experienced the greatest performance. The undervalued stocks produced roughly double the cumulative gain of the fair and overvalued groups. Just as a point of reference, the S&P gained 2.7% annually over the same period for a total gain of 30.5%. It's also prudent to point out that the reduced probability of loss by investing in undervalued stocks with highly predictable earnings histories. For the stocks in the two groups we showed previously, there was only a 2% probability of loss if held for 10 years. This is in strong contrast to the 37% of stocks that lost money over the same period among our total list of 2,403 studied stocks. The conclusions of our findings are relatively straightforward. We have already proven that predictable businesses fare better over the course of a full business cycle than those with less predictable track records. By then applying a measure of value to the already superior list of stock candidates, Buffett further increases his annual returns. Fourth, an economic moat. Another of Buffett's favorite terms to throw around is this economic moat, but this refers to a company's competitive advantage over its competition and the ability to charge a premium for its products or services without losing business to lower cost alternatives. Coca-Cola, for example, has a very strong economic moat. It's one of the most recognized brands in the world, and its syrup formulas are secret and protected. Most consumers will choose a Coke over alternative choices. Google is another example of a moat. It's got a proprietary search algorithm and extensive database that give the company a clear advantage over new and existing competition. To measure whether or not a company has a moat as defined by Buffett, we'll be examining their profit margins. If a business has no moat, over time, others will get into the same business and cause the original firm to lower its prices. This will cause profit margins to shrink. If, however, a firm is able to expand its profit margin while growing its business and not incurring excess debt to do so, this represents a brand with a strong moat. To test the benefit of this final investment benchmark, a screen was set up to scan for the following metrics. This is going to be all inclusive. 1, a high predictability ranking. 2, maintaining or expanding profit margins while incurring little debt while growing the business, and fair valued or undervalued using PEPG. Now again, this is going to include all the previous investment criterion that we've gone through up to this point. Now, unfortunately, profit margin data in the database only goes back 10 years from today, and since we'll want to use the preceding fiscal year's data to make our decisions, we'll be forced to analyze years 2005 to 2013. But this still gives us a nice 9-year period from which to judge stock performance. Using a custom screener, we can backtest our data and compare the cumulative performance of this Buffett-style portfolio to the S&P 500 index. Here are our results. While our screener did not outperform the market in each of the 9 years, the end result highlights some pretty clear outperformance. As we work through the individual years used in this study, notice that our Buffett-style screener outperformed the S&P index almost every year. Extremely notable as well as 2008. In the worst economic downturn of the last century, Buffett's formula lost a very small in comparison 5.6%. And at the end of the day, over the full period that we have complete data for, using all three of Buffett's investment criterion, the total gain earned by this screener was a staggering 313% compared to 59.7% from the S&P 500. $100,000 held in an S&P index fund would have been worth $159,721 at the end of our test period. That same investment would have been valued at $413,406 by investing only in stocks meeting Buffett's basic criteria. That's more than 2.5 times the ending balance over just a 9-year period. Combined, these four basic metrics can filter the market down to a narrow list of high-quality stocks for longer-term investors. To buy like Buffett, just keep it simple. 1. Simple businesses that you understand. 2. With predictable and proven earnings history. 3. Being offered at a fair or undervalued price. And 4. With an economic moat.